Good evening, everyone. Welcome to the 17th session of Young Excellence Women and Young Members Excellence Committee's Friday Symposium. This is a series of sessions held on Fridays, which is an initiative of this committee to not only disseminate knowledge, but also to give young chartered accountants a platform at a national level to participate and showcase their skills and develop their skills and share their knowledge. And anybody who is interested in taking part in these seminars, either as a speaker or as a coordinator, please feel free to reach out to any one of us. Today, we have CA Anurag Shah with us, who will be speaking with us on a very important topic from the perspective of personal finance, which is relating to credit ratings. I'm sure a lot of us have heard कि आपका credit score क्या होना चाहिए, क्या नहीं होना चाहिए, right? And how these things work. He's a person who works behind the scenes in these things, and it will be a great help for all of us to have his insights today. And before we delay any further, I would like to call upon Mittal Sangoi to give a brief formal introduction of our speaker for the day.
Thank you, Deep. Good afternoon to everyone. It's my privilege to formally introduce today's speaker, CA Anurag Shah. He's chartered accountant by qualification and has cleared CS and CFA level 1 exam. CA Anurag Shah has more than 15 years of experience in banking and risk ratings. He has worked with leading foreign banks and India's leading credit rating agency, CRISIL. He has been working with Bank of India, HDFC Bank, where he has leading their internal rating teams, where the entire rating process was set up and managed for HDFC Bank borrowers. Currently, he's managing portfolio of 15,000 crores of healthcare equipment finance and commercial vehicle portfolio for HDFC Bank. With this, I would welcome CA Anurag Shah with big heartiest round of applause. Thank you.
Thank you, Mittal. Anurag bhai, the stage is yours.
Okay. So good evening, everybody. Am I audible?
Yeah, perfectly clear.
Great. Okay. So I'll just share my PPT and then we can just start. Okay. So I presume my screen is visible and the PPT is visible. Great. Thank you. Thank you. So thank you for this opportunity. I would just briefly touch upon what I'm going to cover in today's webinar, in today's session. As the topic says right in front of you, insights to credit ratings, why, what, and how of it, and what are the opportunities that a chartered accountant has in this entire credit rating process, be it not just for individuals, which is reflected in your CIBIL score or your bureau scores, but also for entities, corporate entities, which is an external credit rating given by CRISIL, CARE, ICRA in India. And if we speak of globally, S&P's, Moody's, and Fitch. So we as chartered accountants have a lot of insights, and we are involved in a lot of the processes and the information that a credit rating agency would need for undertaking a ratings. And that's how our role as chartered accountants is very, very important and critical in terms of how do we share the information and how do we present the information to the external rating agency who is rating the company, or for that matter, if it's a CIBIL score, how do you manage that CIBIL score or ensure that the CIBIL score is not adversely impacted by any of the adverse impacts or adverse effects which can impact your eligibility for loan or interest rates. So quickly moving on, as I said, why do we need credit ratings is what we'll cover. What are credit ratings is what we'll cover. Then we'll move on to which are the major credit rating agencies, what are the credit rating scales that a credit rating agency uses, how are these ratings done, and factors impacting credit rating. Apart from that, we'll also cover ECG ratings, and which is a upcoming topic and which you must be hearing every now and then, which is your environmental, social, and governance ratings, which is a new concept which has come in the market and in the finance space. And last but not the least, the credit rating, the CIBIL score or the bureau scores. What are these scores, how they are calculated, and how you can improve or maintain your scores, right? Can I move ahead? Yeah. So as we say, why are credit ratings important? So first and the foremost thing that comes to our mind is how does a company improve its image in the market? How can they do that? Possibly by credit ratings. How can you or a company improve its financial image and create positive publicity for itself? That's where a credit rating comes into picture. Maybe if the company wants to sell or market itself so that it can attract funds or borrow from the financial markets, that's where credit rating plays an important part. And when you borrow from the market, how can you reduce or borrow it, make these borrowings at the lowest possible cost? That's where again a credit rating comes into the picture. This is from a perspective of a borrower. So if you ask me what is it that the borrower has by getting itself rated, or what will it get out of it? These are some of the points which are very, very critical and very, very important for a successful organization to grow and grow both business-wise and financially. It can basically help the borrower to improve its public image and showcase its financial strength and position. It has a good credit rating allows the borrower to have a better negotiating power with its bankers, with its customers, with its suppliers. It helps in attracting investors and bankers alike. It also is a tool which helps you to have a easier regulatory compliance and have a better market reputation. It allows you to have a easier access to capital markets to raise funds at a lower cost. It also allows you to reach optimum capital structure and helps the borrower also not by its own rating, but by the ratings of the customers that it deals with, all the suppliers that it deals with. Looking at their ratings, it can also better risk manage and manage its data as well. These are some of the critical benefits or important points which help a borrower when it gets itself rated. Right? Deep, am I audible and can we move ahead? Is it fine? Deep, Jaya?
Yeah, sir. It's all good. We can move
Good.
on.
Great. So we saw this from a borrower's perspective as to how or what are the benefits that it will have by getting itself rated by an external credit rating agency. Now, from an investor's perspective, also, a credit rating is very, very useful and of great benefits. So, if you ask me, how does a bank or a lender or an investor decide whom to lend or invest its limited amount of money? A banker doesn't have an unlimited amount of money. He has a finite amount. Now, if he has to lend it to somebody, he would like to have a comparative analysis or a tool for comparing all the borrowers that are that have applied for loan to its bank and decide who are the best of the guys or which are the best applications that it has got and who are the worst ones who will default or who will not return their money. So a credit rating helps and comes into the picture at this for this particular purpose. Now, if it can lend to just for that matter everyone, say for example, how do you still decide at what interest rate that you will charge all of these borrowers? So, of course, if the company is of great market strength and great market repute, say, for example, in Indian context, a Tata or a Reliance or a Birla, they would like to have the lowest possible interest rate to be charged to them. And similarly, the same in the same lines, if you have a normal SME or an MSME setup company who would want to borrow, their interest rate is something which you will want to decide looking at their credit ratings for that matter. More importantly, also, even if you are able to manage to decide on the number of customers that you would want to lend to and at what interest rate, there is another important aspect where credit rating comes into picture and helps you is to decide how much capital or buffer money that a bank should keep aside for the loans that it has given. This buffer money is something or capital is something which comes in handy when at the end, if at all you have defaults, how much of the entire population will default will depend upon what is the kind of creditworthiness or weighted average ratings that the portfolio has. The lower the rating, the higher the probability of default. The better the rating, the lower the probability of default. And if the probability of default is low, the capital that is required to be kept aside will be obviously low. And if it's the other way around, wherein if the probability of default is high, the capital that is required to be kept aside will be higher. So that's how credit ratings help the investor in investment decision making, better risk management and diversification, better transparency and surveillance mechanism that it can lend to. It is an independent third-party assessment and monitoring of the investments that you make. So there is an external rating agency who is a third party and who will give you an independent view as to how the company is performing and how its financial and business strengths are either improving or deteriorating. It also obviously will help the investor to decide the interest rate, or not the investor, but the banker to decide the interest rate at which it would want to lend. Apart from that, it would help you help the bank to manage the credit risk and do an estimation of risk capital assessment and allocation in a much better way. That's where, again, all of these credit ratings help and play a very, very critical role. Now that we have understood why do we do ratings, let's understand what are these credit ratings to. So credit ratings per se is nothing but an assessment of credit worthiness of a borrower or an issuer of debt instruments such as a corporation, government entity, or an individual or a corporate entity. So it is nothing but an assessment of credit worthiness. What do you mean by credit worthiness? Is primarily to say how much or what is the probability of default if you give a XYZ company or an ABC corporation the money. What is the probability of default, or what is the probability of he returning you back that money in full and making all your repayments in time? So that's what a credit rating indicate or credit rating assessment gives you. It's nothing but an evaluation by credit rating agencies to opine on the borrower's ability to meet its financial obligations. So whatever borrowing that a corporation or an entity does, whether that borrowing will be paid on time and what is the probability that it will be paid on time, that opinion is given by a credit rating agency, and that opinion is nothing but a credit rating of that borrower or of that company. It is, in simple words, it's basically a relative ranking arrived by systematic analysis of strength and weaknesses of an entity or an individual based on its business and competitive strengths and its present and future financial statements at a given point in time. So it's nothing but an analysis and basically a final end result to give you a credit rating assessment, which is again a relative grading amongst all the borrowers. Each borrower is rated on a specific scale, and within that specific scale, certain borrowers will be classified as better rated entities, and the other half, which is at the lower end of that rating scale or the ranking mechanism, will be lower rated entities. It's basically a measurement tool to measure the riskiness of the borrower or its probability of default over a given period of time. They basically assist investors and creditors in making informed decisions regarding risk associated with lending and investing in a particular entity. Right? So, if you ask me, it's basically a report card of a corporation or of an entity, just like exam result report card that we had when we were in school. The only difference here being it's a grading mechanism wherein you don't get marks out of 100 to say that you have scored an X amount, but you are rated and put on one particular common scale, and again still bases your scores that you achieve in your exam, but you will be given a rank. So that ranking is something what you call as credit ratings for a company, right? Moving on, which are the major credit rating agencies, both globally and in India? So if you ask me, globally, it's a very highly concentrated industry, wherein only three credit rating agencies control majority of the market share. Almost 90 to 95% of the market share is with S&P Global, Moody's Corporation. Both of these make up almost 80% of the market share, and Fitch, which does balance 10 to 15%, and 5% could be in some countries wherever there are that country's domestically grown rating agency that could possibly corner some 5% odd. Otherwise, 100% of the market is captured by these three leading external rating agency globally. Now, similarly, in the Indian context, SEBI and RBI are the guys who regulate and license a credit rating agency. Not everybody is allowed to operate and be recognized as a credit rating agency. And for that matter, until this point in time, SEBI and RBI currently have given this license and this authority to 6 rating agencies. Actually, there were 7 earlier, but recently the 7th one has been the license has been revoked and withdrawn, which is given to Brickworks. I'm not too sure whether you would have heard about it or not. If you Google it, it was some 6 months back when SEBI has revoked its license given to Brickworks, primarily because of issues with respect to the quality of ratings that it was giving out, and some issues in the regulation and the compliance that it had to follow. But keeping Brickworks out, currently still there are some 6 rating agencies, within which CRISIL, ICRA, CARE, and India Ratings are the 4 major external rating agencies in India, which capture almost, again, 80 to 85% of the market. The second large being Acute Ratings, which is basically earlier was called as SMERA, or Small Scale Industry, or SIDBI promoted rating agency, which has now changed its name to Acute Ratings. And last but not the least, the latest rating agency is called Infomerics, which has got a license from SEBI and RBI. If you see, even within the Indian context, CRISIL is a subsidiary of S&P Global, ICRA is a subsidiary of Moody's, and India Ratings is a subsidiary of Fitch. So the 3 global rating agencies also operate in India through their subsidiaries. And again, here they have a sizable market share, where CRISIL as a leading market player was almost having 35 to 40% market share. Gradually has come down slightly of late. What is the rating scale that it rates these borrowers at? We'll come to that. Primarily, the best rating is the AAA rating. It's the highest possible rating, where it starts from, and it goes up to C or D, which is the lowest rating. And within this, there are almost 6 other layers of rating, which starts from AA, A, BBB, BB, single B, and C. And all of these have modifiers. So effectively, you have a 20-point scale on which most of these borrowers are rated. So within this 20-point scale, as I said, AAA is the best. From there on, AA plus is the next best rating. And plus and minuses are the modifiers. So the one which is having a plus rating is higher. There is one grade in between which doesn't have any rating, any modifier, which is called as AA, and which is the next rating scale, and below that is AA minus. So the rating of AA plus is 1 notch higher as compared to AA, while AA minus is 1 notch lower than AA. Okay. While globally, each rating agency uses slightly different scale, and they assign each of these ratings in the form of letters. However, within the Indian context, one good thing which SEBI and RBI recently did was our scales are same. So it's a 20-point scale, which is standard across all these 6 rating agencies, which helps you in making a comparison very, very easy. and it is easily comparable, and there is no differentiation. The only differentiation that they have is they add their own company name in front of the rating. So borrower rated by CRISIL AAA will be called as CRISIL AAA. The next rating is CRISIL AA, CRISIL AA plus, CRISIL AA, and CRISIL AA minus. So similarly, you can have a ICRA AA, AAA plus, AAA, AA plus, AA minus, right? So that's a good part. That our rating scale is standard and across all rating agencies. So this is the rating scale that I was talking about. It's basically a 20-point scaler where it starts with a which starts with a AAA, which is the best and the highest possible rating, and it indicates highest credit quality with lowest risk of default. Then it moves on to AA, triple B, double B, B, C, and D. Now, as I said, apart from AAA and D, all the other 6 scales have a plus and a minus as modifiers. So these 6 rating scales, 1, AA, A, 2, 3, 4, 5, and 6. This 6, if you multiply by 3, you will get 18 points, and the AAA and D makes it 20-point scaler. Similarly, this is a long-term rating scale. So any rating done for a facility or a bank facility or a financial instrument which has a tenure of more than a year or so will be rated on a long-term rating scale. All the others which are having a tenure of less than a year or 12 months will be rated on a short-term rating scale, and here the rating scale is slightly different. So it starts from A1 and goes up to D, wherein A1, A2, A3, and A4, all of these have only a single modifier, which is a plus rating. So these are, it starts from A1 plus, A1, A2 plus, A2, A3 plus, A3, A4 plus, A, and D. That way it makes 9-point scalar. Again, here the highest rating credit quality is indicated by A1 plus rating, and which has the lowest possible rating, and a D is a default rating wherein either default has already happened or is likely to happen in the near future. Right? So now within this rating scale, the highest possible rating is the one which attracts the highest amount of capital at the lowest possible interest rate, and helps the borrower to attract most number of investors. All the bankers will be interested to lend to it. An example of the same will be Reliance, which is rated at a AAA, or a Tata Group company, your TCS and others who are rated at a AAA. And these are the borrowers which have the benefit of lowest interest rates and highest available capital to them, or funding available to them for their funding needs or for their capex needs or any business purpose needs, right? And a company rated in the lower end of the spectrum, which is a B or a C or a D, either will not get capital. Obviously, if it's already a D rated, which indicates default or default is imminent, no banker would obviously lend to such borrowers. And if you are slightly better off at a B or a C or a double B, again, while you might get funding, maybe not at C, but only at a double B or a single B category, but you will get it at the highest possible interest rate. So that debt will be costly, and you will get only a limited amount, and few bankers who would want to lend to you. So there's a terminology within this rating scale, which is investment grade ratings and non-investment grade ratings. When you say investment grade ratings, it's basically a cutoff which is there at a triple B minus. So this scale, or at this point, is where triple B minus is where all the ratings are called as investment grade ratings. So triple A to triple B minus is where investment grade ratings are available, and double B and below are non-investment grade ratings, which basically are means that either these are not investable companies, or at least even if you do invest, the risk is higher in such companies. Okay. So here, just to give you an example, I've just taken CRISIL, which is a leading rating agency. All the various types of rating scales that it operates into, wherein we have largely seen the first two columns, which was long-term rating scale and short-term rating scale. But apart from that, there could be a structured finance rating scale, which is indicated by adding an SO to the ratings, which is to say that there is a structured finance or a rating support which is available to the borrower, either which could be external in nature or internal in nature, basis which this rating is arrived at. So just to give you an example, a borrower's rating sometimes could be weaker and on an individual scale will be within the non-investable grade. But if you have a structured rating, that's where your rating can be improved upon, and you can officially get a better rating. To give you an example, as of yesterday, there was a Geo Financial NBFC which has been demerged out of Geo or Reliance per se. Now, this company or this NBFC, while has been demerged, its business strength and its market position within the NBFC space is not so great, even though despite being carrying a Reliance name to it or a Geo name to it. If somebody has to rate this particular company, which is relatively new in the market, has not established its product or its business strength, its rating will be somewhere in the lower investment grade, or maybe just about within triple B minus. But if at all there is a corporate guarantee available from Reliance, or a letter of comfort which is available from Reliance for its debt, then the borrower, or for that matter, here the NBFC can go to the external rating agency and ask for a structured finance rating. And within this structured obligation or a structured finance rating, its rating will, because of the guarantee or the letter of comfort that is available from Reliance Industries Limited itself, its rating could be improved by several notches and could possibly well be into CRISIL AAA rating category. So here, more importantly, there are two aspects to keep in mind. An SO rating or a structured finance rating per se is not just an indication of the borrower's creditworthiness, but it takes benefit out of a structured obligation or a structured benefit that is arrived or that is put in place in the form of external support, as in this example that we took of Reliance Industries Limited. And that's how the rating is arrived at.
Anurag sir, I think you're not audible.
Yeah, I just got a call. I just got a call on my mobile. I might have to step out for 5 minutes. Can I do that? There's something urgent which has come up.
Yeah, yes.
Yeah, just a second. Thank you. Hello. Yeah. Can we start? Okay, great. So, as I was saying, these structured finance ratings are ratings which are different and which are not comparable to the normal issuer ratings that we have on the left-hand side in the first two columns. These are supported by an external support or an internal support, which is factored into this ratings. Apart from that, there are three other rating scales which are used by CRISIL or given by CRISIL. Corporate credit rating scale, which is similar to the rating scale that we have normally here, which starts again here from AAA to SD. And apart from that, there is a fixed deposit rating scale. So all these companies who take fixed deposits, they are mandatorily required to, if they take deposits from the public, they are required to mandatorily get itself rated. And here the rating scale starts from F AAA. F stands for fixed deposit ratings, and it starts from AAA, AA, A, B, C, and D. So you don't have a triple B and a double B here, right? And last but not the least, there is a financial strength rating scale, which generally is derived only from the financial strength of the company. All these rating scales or ratings again have a plus or minus available to them. And as I said, on the long-term scale, there are some 20-point scaler, and on the short-term scale, there are some 9-point scaler. So, having looked at the rating scale, let's also look at what are the other terminologies that are used in the ratings space. There is a rating outlook and a rating watch, which is used and associated with each company's rating. And what is it that it means is nothing but it gives you an outlook is nothing but an direction of or it indicates the direction in which the rating is likely to move in the next year or two. So over the medium term, whether the rating is likely to be upgraded or downgraded, or whether it will remain the same over the next year. So a positive outlook is something which indicates that there is a material chance of rating being upgraded over the medium term. So each rating scale that we saw in the previous slide, say for example, a CRISIL B rated guy will have a stable positive or a negative outlook associated with it. If he has a CRISIL B with a positive outlook, it means that the rating will move from a CRISIL B to a CRISIL B plus. Similarly, a triple B minus rated entity could have a negative outlook associated to it. So a triple B minus with a negative outlook simply indicates that there is a chance of that rating being downgraded from a triple B minus to a lower rating category, which is a CRISIL double B plus. So sometimes people and borrowers especially get too finicky about the outlook per se, and they sometimes feel that a negative outlook is something which effectively, yes, on the face of it says or indicates something negative about the company, but however it has to be seen in the context of the ratings. So as a chartered accountant, why I'm actually dwelling too much into this rating scales is to try and understand what So when you get a rating for the clients or the customers whom you are doing an audit for, you should try and understand where these ratings lie and where is that the company is put on this rating scale, and explain this rating scale to the customer. Sometimes many people accept a lower rating with a stable outlook as compared to a higher rating with a negative outlook, which is not correct. So if a borrower is rated, say, for example, A minus or A with a negative outlook, that A with a negative outlook is better as compared to a triple B plus, which is a a lower rating category and with a stable or a positive outlook. The outlook is only going to indicate the direction of the ratings, and it doesn't indicate the credit worthiness of the borrower. The rating is something which is indicating the credit worthiness of the borrower, and that's where one should be mindful while accepting a rating as to whether that rating is higher, even though the outlook could be negative, right? So you have a rating outlook which indicates the positive, which indicates the direction of the ratings, either which could be positive, stable, or negative. And then there is a rating watch. What is a watch is again something which indicates direction of the ratings itself, but this is something which indicates the direction in the very short term. And this is used when there is a material change or a sudden change which happens in the borrower and is likely to impact the ratings of that borrower. So the when there is a rating watch, company placed under rating watch, a credit rating agency basically means that within 6 months to 9 months, once there is a clarity of that change that has happened or is likely to happen, emerges, the rating will be finally decided. So this is something which is very regularly used when there is a merger which is happening or an acquisition which is happening between two companies. And say, for example, suppose both of these companies are already rated, and just like say, to take an example, Adani recently acquired Ambuja Cement and ACC Cement. At that point in time, during the announcement, typically the rating agencies put these companies' rating on a rating watch with giving a signal, just like in cricket, an on-field umpire gives a soft signal whether it's an out or a not out. Whether this is an soft signal by the rating agency, if it says rating watch with positive implications, which means the rating is likely to improve. If it says it is placed on a rating watch with negative implication, it means that the rating is likely to be downgraded. And if it says developing implication, that means they are still not able to decide on whether the rating will be impacted and in which direction, and they will want more clarity and time before they would want to indicate the direction, right? So this is the basically a chart giving you a comparison of the rating outlook versus rating watch. As I said, rating watch is used typically for a very short period of time, as mentioned here, 90 days to 6 months. Here the duration is 6 months to 2 years. It is applicable or assigned to long-term guaranteed long-term fixed deposit scales. It is applicable to all instruments, including short-term ratings, right? Moving on, how are ratings done is something which one should be having a knowledge of, so that you can help the companies or the borrowers who are getting rated and for whom you must be doing an audit or an internal audit, or for that matter, handling their accounts. These entire ratings are dependent upon the financial statement and the disclosures that the company makes. And hence, while these financial statements are being prepared, if you know how an external rating agency is going to view your financials and what impact it will have on the ratings, you can better, I would say, better present and better put your financials or decide your financials in or place your financials in a better way for the rating agency to look at it favorably and obviously then impact your rating in a positive way. So, a credit rating process involves extensive analysis and research. This analysis and research is basically done by gathering information through company disclosures, financial statements, meetings with the management. Here again, as a chartered accountant, you could be part of these management discussions when the company or the external rating agency comes or the analytical team of these agency come and meet the management. You as a chartered accountant should be part of those discussions to handle the financial queries that these external rating agencies might have and better present the client's perspective to the external rating agency. From industry reports is companies' business policy, strategy, documents, and competitive positioning. Its annual reports, its quarterly financial statements, all of which that the company discloses on a regular basis if it's a listed company on a quarterly basis, and its risk management practices and policies that the company has. These are some of the areas from where the external credit rating agency pick up the information from and then arrive at the rating. The final rating is based on external credit ratings judgment and is subject to periodic reviews. So there is no mathematical formula here that the external rating agencies have. And which is why it is called as subjective ratings, wherein it applies its own expert judgment on the borrower's business strength, which cannot be quantified financially and decide upon the ratings. So it becomes very, very critical to ensure that this subjective scoring that the external rating agency is likely to do and an assessment that it is likely to do of the business strength is done in a correct way and in a favorable way for the borrower or the customer or our client. That is very, very critical. I'll have to take a break here, Jaya. I guess my So this was something. This is the difference between a rating outlook and a rating watch, and these are also used in the ratings that the external rating agencies communicate to the borrower. Moving on to the next slide, as we were saying, how is it that the credit ratings are done? So sorry, I don't know who's recording it, but I guess you'll have to edit this bit since we were already on credit ratings, how these were done, right? So I'll again start. Credit ratings, as we saw, the external rating agencies undertake these credit ratings primarily through these sources of information. And at the end of the day, this credit ratings are nothing but a credit rating agency's opinion or a judgment. Okay. Diving a little more deeper in terms of how these credit ratings are done for a corporate and what are the parameters that one looks at. So there are 5 broad parameters under which most of these rating agencies assess a borrower. These 5 parameters largely are: 1, industry risk scores or industry risk assessment, business risk assessment, financial risk assessment, management risk assessment, and repayment track record and ability and willingness to repay the debt. These are the broad 5 contours under which the entire rating assessment is undertaken for each borrower and arrived at. Within each of these 5, now we'll go through. There are several parameters that are being assessed for a particular borrower, and basis which a rating is overall arrived at. So first and foremost being industry risk scores. This is being assessed basis what is the government policy for a particular industry, what are the industry trends, what is that the demand or the supply trends talk of or indicate, whether there is a situation of oversupply or whether there is a situation of undersupply and high demand, which argues well for or any company associated with such a industry where demand is high but the supply is low. And last but not the least, what is the technological or the regulatory risk for a particular industry? So say, just to take an example, you have a borrower which is related to a steel industry, right? So what is it that the government policies talks of with respect to the steel industry of late? Is it having some sort of duties, import duties to protect its domestic industry, or is it which indicates that the government is supportive of that industry, or is it against that industry? To take an example in the recent space, the online gaming industry, which has developed and grown into a big industry. There the government doesn't want the industry to flourish unattended and uncontrollably, and that's how it has applied 28% GST, which is the highest rate within the GST space, which has been applied to this particular industry, and all your winnings from this particular industry of online gaming is being taxed at 28%. So government policies, are they favorable or unfavorable, depending upon which the industry risk scores will be uh, scored in a better way or a worse off way. Demand and supply position, again, here if you look at, just to take an example, recently if you see food industry or specifically tomatoes, they are short in supply. Similarly, so any company which is making food products related to tomatoes or say for example potatoes, potato chip manufacturers, which are snacks industries, which are many of which take bank loans, they are rated. So what has been the industry trends for such an industry will decide upon or will impact the overall industry risk score. Technological risk is something where the industry is dependent upon technology. And here again, the best example is mobile phones. So a manufacturer who is manufacturing mobile phones or smartware gadgets, there the technological risk is very, very high. The technology is fast moving and keeps changing regularly and very quickly. So a rating agency assesses all these parameters and arrives at the overall industry risk score for a particular borrower. Similarly, businesses scores is where the external rating agency largely focuses on the company's business strengths. And by business strength, what we mean is its market position, how is this product faring, what is the kind of diversification that it has within its revenue mix, whether most of its revenues are concentrated from few borrowers or is it widely spread, whether the product mix is competitive, whether it has large variety of products or is it concentrated with one or two star products and all its revenue is coming only from one or two products. Say for example, a couple of years back or a few years back, Nestle was a company where Maggie was its star product, which was contributing almost 70 to 80% of its revenue, had a negative news about health issues and quality issues that Maggie has, and which impacted Nestle's revenues drastically. A concentration in its product risk, product mix is something which is adversely looked at by a rating agency. A well diversified and a well distributed revenue mix, product wise or geography wise, is favorably looked at and scored at by a rating agency for a particular borrower. What is the market share and the market position of the company within its market? Again, here, as a chartered accountant, you should guide your customers to or clientele to possibly explain the market in a better way to the external rating agency, wherein you define the market appropriately, which showcases the fact that you are a market leader and you have a sizable market share and market position, which will be looked at favorably when external rating agency is giving a business score to the client. So defining the market and having the market share in handy, and also possibly giving out details of the competition that is there and how the client is different or the client's products are different as compared to the market and its competition is something which is very, very critical. And as a chartered accountant, you can help your customer showcase this better. Just to give you an example, bathroom fittings. You have a Jaguar, which is there who is a market leader and who has been in existence in this industry for a long time. Now, if you see the market share for Jaguar within bathroom fittings will be very good. But of late, Jaguar has also put itself into lighting solutions. Now, if both these revenues or businesses are within the same company and you are rating that particular company, while the market share within bathroom fittings will be coming out to be very good and the company will be favorably rated and scored, within the lighting space, it will have a excuse me, it will have a very bad score or a negative score because its market share is not good. But here again, if you define the market well enough and you say that Jaguar is not into all kind of electrical products, it is only into decorative lighting solutions. There, obviously, Jaguar is one of the few branded players who have ventured into decorative market space. So this is something which you, as a customer and as a chartered accountant, you should be able to come up with while you're discussing or before you're discussing with the rating agency as to how will you position yourself. Apart from that, how well there is backward and forward integration in the market that it operates into and in the production line that it has. If you are backward integrated well enough, your supply shocks or shocks from increase in raw material prices will be limited and you will be in a better position to absorb those market shocks. So for a snacks company again, if the company has backward integration wherein it has fixed tie-ups with the farmers, or maybe he himself is farming, say a Balaji wafer or a diamond wafer, or for that matter Lay's. If it has fixed contracts with farmers for a particular quantity at a fixed rate, then whatever be the price of potatoes in that particular year in the market, there is a backward integration available to these snack manufacturers and it will not be impacted due to a movement of potato prices year on year. And there could be industry specific parameters. If you're looking at a steel company, backward integration, forward integration, raw material supply chain and protection is something which will be critical. For a snack manufacturer, branding will be important. He needs to brand itself and ensure that it has a good public image which allows it to charge premium from its customers. For an automotive company or a car manufacturer, branding is important. But an auto ancillary, consumer facing industries, branding is important. But for non-consumer B2B industries, branding is not important. So these industry specific parameters is something, but is something which is important and which should be showcased correctly. Apart from that, there is a plethora of moving on to the third and the important pillar is the financial risk scores that is assessed at. And here, as I was saying, there is a plethora of ratios which are assessed by the company or by the external rating agency and arrived at the financial risk score. So within this financial risk score, TOL by TNW, debt by equity, debt related all the ratios, DACR, debt by EBITDA or FCF, and working capital cycle and data cycle, or maybe up till here, the ratios, the higher they are considered to be bad. And these financial risk scores will be adversely impacted. So a TOL by TNW above 3 times, 4 times, 5 times indicates that your liability, outside liability, is 6 times more as compared to the net worth. And accordingly, your financial risk scores will be lower rated. Similarly, for debt by equity. So here, all these ratios, the lower they are better, the higher they are worse off. Except for DACR, where DACR, the higher the better, and the DACR, which is lower or less than 1, is considered to be adverse. Similarly, for working capital cycle, the lower the ratios, the lower the working capital cycle, the better it is for the company. And that's how, when you're looking at the financial ratio, you should be mindful while you're finalizing these balance sheet ratios. If for one particular day, if you could maintain, say, a data level to the lowest, or maintain, if the company is likely to infuse capital the next year, you try and bring that capital maybe upfront before the balance sheet date. That is something which you could advise to the company. If the company is likely to draw down fresh debt, maybe you should ask the company to wait for a few days and take that drawdown maybe after 31st of March. Because that balance sheet, that debt amount otherwise will sit on the balance sheet and will have an adverse impact on the financial ratios. Similarly, there are, apart from these balance sheet ratios and ratios which are largely related to debt or equity or the asset side, there are ratios on the P&L side, which here again, the higher the better they are, and the lower the worse off they are. So a sales growth, a company growing consistently year on year, is something which is positively looked at by the company, by the external rating agency. The operating margin, profitability ratios are something which again the external rating agencies looks at very, very carefully, and the higher the better, the stable the better, the consistent that they are, it is better. So while you are finalizing the P&L ratios also, one should look at whether the ratios are either stable or on the improving trend. And if they are on the decreasing trend, during the management discussions that the company is having, one should explain the reasons very, very clearly to the external rating agency as to why the ratio has been adversely impacted and the profitability has gone down in a particular year, and then support it with the latest numbers if it has improved, and if it is not likely to improve, what is the reason behind it, and what is the company doing to improve its profitability margin, so bring it back. What is the promoter contribution or the net worth in the balance sheet that is there is also important, and the higher the better again for this particular ratio. Apart from that, management risk is the fourth parameter and the fourth overall pillar, which is assessed by the company or the external rating agency. Here, the management competency and its experience, its style, its past track record. When I say management style, whether it is aggressive or whether it is conservative, whether it is balanced or whether it is consistent in its approach or non-consistent in its approach. This is something which is very, very important and very critically looked at while the external rating agency is assessing the company. So to give you an example, Adani will be considered currently as an aggressive management style, which is primarily because the goals that it is setting up for its growth or profitability or market share that it wants to operate, or the market position that it wants its company to reach at, is very, very aggressive, for which while if the company is successful and the management is successful, it can bring in results, but the risks are also higher. Just like in cricket, if you have an aggressive batting style, the risk or the chances of him, the player, getting out is obviously higher as compared to the one who is playing conservatively and who is not taking that much risk, or who is stably batting with a stable mind or stable style. Right, the transparency and the promptness of data sharing is also critical. How transparent the management is to the external rating agency is something which will comfort the external rating agency and works in the benefit of the overall rating score that you will have. What is the succession planning if at all the management or the company has very senior and old management? What is the next? Who is the next line of management which is likely to come in, and how are they planning the succession is also something which the external rating agency look at very carefully. And of course, the auditor's report and the quality of the auditor and the report that it gives, if there are more qualifications in the audit report, it is adversely looked at. If there are no qualifications and it is clean audit report that the auditor is giving or we are giving to the company, it is positively looked at. And while you can assess all of these parameters, the fifth parameter is the most critical and the most what I may call as litmus test for a company, which is whether, while all of the other parameters indicate the ability of the company to repay its debt, the more important parameter is willingness to repay. And this is where, if I have to rate a Byju's for that matter as of current moment, while its ability will be great and he will score great on most of the other parameters, the willingness is something which is not there with Byju's currently, and the company has filed a claim against its lenders, and which is where it will get its rating will get significantly impacted. So this is something which can make or break a rating. If the everything is hunky dory, but the company has not paid its dues on time, his rating will be adversely impacted, and it won't matter whether it's the strongest in its market or in the industry, it is in the safest industry, or its management is very conservative. All of that, despite being scored and looked at favorably, still the overall rating will come to close to a D or a C. Because if the company has defaulted, that means that company is clearly either likely to default further or very close to default. And which is why willingness and ability both are different, and both are looked at very differently. And this is something again which you during management discussions as a chartered accountant, if you're part of that discussion, can explain and highlight to the rating agency that your track record of repayments has been very spick and span, and you have been paying all your liabilities on time, and maybe even before time. If there has been any prepayment done, you should highlight the same, right? Within this, liquidity status and solvency position and availability of raising financing is also important and critical. If he has ample liquidity, the company's rating will be obviously favorably impacted. But if at all the liquidity is short for the current moment or for the short term, despite everything else being hunky-dory, its rating will be impacted significantly. Just to give you an example, live example from the market, currently Vedanta and Adani were under severe stress, primarily because of its liquidity position. Vedanta still is, wherein the near-term liquidity or near-term repayments that it has is being questioned whether the company will be able to meet its current repayment obligations in the near term, and because of which the rating is adversely impacted. Right. Moving on to the next slide. Again, this is a summary of the same parameters that are there, which I've mentioned in the previous slide. Just here, it's given in a more detailed manner within each of these heads as to what is it that one looks at. And so just to take a quick example, consistent profitability will be assessed by steady revenue growth, healthy gross and net profit margin, effective cost management and control, and positive cash flow generation, right? Say, for example, just to take another one, efficient working capital management will be assessed basis optimal management of cash, receivables, and payables, adequate inventory management. Inventory should be, or working capital is always not just looked at from a past to present perspective or a trend, but also compared with the industry. So you should try and be better than the industry, at least by the year end. You should try and say that your see that your data amount is at the lowest at on the balance sheet date, and your inventory is also at the minimum, right? So moving on to the next slide, as I highlighted during the webinar also, what is the role and the opportunities of a chartered accountant within this external rating process or external rating agency giving a rating to a borrower? In that entire process, how a CA can come into the picture and value add to the entire process is something like this. You first and foremost, you can consult the or give consultancy services to the client for managing the entire end-to-end process of ratings, wherein, as I highlighted, you would be interacting with the external rating agency on behalf of the client. You would be presenting the facts. You would be supplying the information that is required to by the rating agency, and managing the entire rating process. So for companies where the management, while have there will be managements and promoter driven companies who are very good at its business and they are doing well, but when it comes to marketing or presenting their company's financials and explaining the company's financial and market strategy to a third party, they may not be that good. And that's where, as a professional chartered accountant, you can come into the picture and try and explain the same in a much better way and in a much polished way to an external rating agency for them to understand it better. So, as I said, you can provide consultancy services and rating management services. Providing the required information to the credit rating agency and sharing it in a timely manner is also important. And this is something which is where, as a chartered accountant, you might want to give a couple of reports in the format that the external rating agency is asking to be filled in a proper appropriate way and shared with them. Apart from that, preparing financial projections and project plans is also critical. Having projections in place is important and a very critical aspect for an external rating agency, because external rating agency is giving a rating not just basis past performance. In fact, more so it is looking at the future performance and giving you a rating which indicates the probability of default over the near to medium term of a borrower. So it gives more weightage to the projections, and which is why projection should be very, very minutely looked at, assessed, and then submitted to the external rating agency, which are reasonable and are the management is confident of achieving these projections. They shouldn't be overly optimistic and neither should be overly too conservative to adversely impact the ratings. So this is something which you should, you can, as a chartered accountant, better manage and better present these projections and also make estimates and assumptions about how the balance sheet will look like at the year end. Once you give these projections, or if it's an ongoing rating agency's assignment or rating agency, rating consultancy that you are providing, one should also, as a chartered accountant, before the year end, look at what is it that the actual financials look like. Are they in line with your projections, or are they very haywire? If so, you should try and see that the projections are met. And if they are not met, be ready with the reasons, understand the reasons, and present it in a correct and a favorable manner to the external rating agency while they come for review. As I said, ensuring that the financials at the year end are in the best of the shape to show a positive trend in the ratios should be something with the chartered accountant as a chartered accountant, you can take care of. Ensuring that the ratios on the balance sheet components are in the best possible levels is something which you can look at and you can manage. As I said, if there is capital which is likely to come inform that the management that balance sheet may, if it comes before the balance sheet date, it will be useful for your financials, which is not just looked at by the external rating agency, but even your bankers will look at it, and they will also be happy looking at that capital being already coming in the balance sheet before the year end. Or say, for example, it has a data which is outstanding for long, and the company has done some sales only at the year end during the last month of the year. So for that particular sale, you can advise the management to try and ensure that either the payment terms are such that before the year end, the money comes in, or even though that they have to possibly sacrifice some margin on it, or else the other way around, if they are taking the giving the credit and keeping the balance sheet data outstanding on the balance sheet date, one should, as a chartered accountant, you should explain this fact to the external rating agency that just because the company did some significant amount of large sale in the last month, the datas are looking bloated up and they are higher than normal. They in normal regular months are at a much lower level. So this is something which is a finer detail which, as a chartered accountant, only you can provide and explain to the external rating agency, and companies management and companies accountant may not be that well versed capable to showcase the same. So you should, as a chartered accountant, explain this value addition that you bring to the table as a chartered accountant in the entire rating process, and try and take up this assignment on a chargeable basis from the management to manage the entire rating process. Okay. Maintain and highlight the positive outlook of the business is also important. What is it that the management thinks of in terms of near to medium term business prospects of the company is should be always given in a positive way. And this is again something where, as a chartered accountant, you can guide the customer and the client while they are speaking with the external rating agency. Also try and indicate the strong risk management practices that the borrower has, if any, and share it with the CRA or the credit rating agency effectively, and work towards enhancing business profile by reducing customer concentration, improving contribution from high margin products, increasing geographical mix, etc. These are some points which over the medium to long term, if you are associated with the company, gradually you can explain it to the customer that if you try and work upon some of these points and improve upon these points, we can ask for a better rating from the external rating agency the next time that we come up for a review. So just giving you tips in terms of how you can improve your rating and the rating can be upgraded. Of course, the first and the foremost is ensuring that all payments are done on a timely manner is something which is very, very critical and important. You should first and the foremost thing tell the client that this is something which is non-negotiable. Please, if there are any overdues or any EMIs likely to be due, those should be paid on time and should be made good as soon as possible. Otherwise, the rating gets downgraded to a default category and the interest rate that the bank charges will be increased and you will end up in or the customer will end up in a debt trap, which is difficult to come out. Just to briefly touch upon ESG rating, since it's a new concept, I just thought I'll touch briefly upon this. It's basically environmental, social, and governance rating. It measures the company's performance and practices in relation to what environmental, social, and governance factors or practices or impact that it has. It basically assesses companies' commitment to sustainable and responsibly grow itself, and these practices do not have an adverse impact on the environment. That is something which is assessed during these ESG ratings. There are 4 factors which are critical here, basis which these ESG ratings are finalized. And again, here it's an upcoming sector and upcoming area of practice which a chartered accountant can possibly help and guide the customer with. So, as I said, the 4 pillars here are environmental factors. What is the carbon emissions or the climate change strategy that the company has? What is the resources? How efficiently the company uses its resources is something which is being looked at. Waste management practices, environmental compliances, etc. are some of the points which will be assessed here. Social factors are largely to do with employees and human rights or employee related. So what are the labor law compliances that the company has? What is the kind of employee diversity that it maintains? What are the health and safety standards that it keeps in place for its employees? What is it that the company does for product safety or customer satisfaction is something which is evaluated here. Moving on, there are governance factors, which basically is to assess and deal with the company shareholders, the management, and the risk management practices that the company has. Stakeholder engagement and reporting and transparency. So reporting and transparency is basically how transparent the company is in sharing information, how much information with respect to environmental impact the company is sharing in its annual report will be an important factor which will be assessed during ESG rating. It is important to note that these ESG rating methodologies are still evolving. So it's a new concept and different rating agencies have their own unique approaches and weightage system for assessing the ESG factors. So this is an ongoing process and it's still under development stage and it differs from rating agencies to agency. It may not be same for every rating agency. It is still not standardized. Additionally, regulatory frameworks and reporting of standards related to ESG are also evolving, which can impact the parameters and methodologies used for ESG assessment. Even here, a chartered accountant can play a critical role of helping in calculation and assessment of the above ESG parameters. So how it is assessed, how it is presented is important, and as a chartered accountant or a professional, you can help the customer and the client to better present its story to the agency who is doing the ASG. So this was all about corporate ratings and entities rating. What is the creditworthiness of an entity, right? Similarly, there is a similar credit score, which is not a credit rating, but a credit score as it is called, or a bureau score for an individual to be rated. So we'll briefly touch upon that. And here, again, as a chartered accountant, you can come into the picture to try and help the customer manage its credit score better, and also ensure that he does not do anything which impacts its credit score adversely. So a bureau score or a credit score is basically a numeric score indicating individual's credit worthiness. Here, as we spoke of a couple of minutes back, credit score is a relative grading comparison. It's a ranking. Sorry, credit ratings is a ranking. Credit score is basically marks that you get in your exam. So here, out of 350, out of 900, what is your score between 350 to 900 is what indicates the credit worthiness of the individual. The higher, the better it is. Therefore, credit rating, credit scores or bureau scores, Equifax, Experian, CRIF, and TransUnion here. Moving on, as I said, ensuring again your timely repayments, reducing debt, avoiding full usage of your credit cards, having a diversified credit mix or debt, and monitoring the credit reports for any inaccuracy. All of these factors are some of these factors which is how you will impact your credit score. And if you manage this well as a chartered accountant, your individual returns which you file, those guys can have an easier terms in its loans that it applies for, and it gets a lowest possible interest rate from its lenders or bankers. That's it. Thank you. These are my personal details. If anybody wants to get in touch with respect to credit ratings or banking, I shall be more than happy to help. Right? Thanks, Jaya. Thanks, everybody, for a patient hearing.
Thank you, Anurag sir. It was such a wonderful session listening to all the presentation and everything, listening to you. I would ask the participants if they have any questions to please write it down on the chat box, and we'll take up those questions now. Until then, when you said about ECG, right now we already have top 1,000 companies who have to comply with BRSR reporting. However, this recent SEBI notification that had come up, I think it has opened a lot of opportunities for, they've listed till AY 26-27, and they've given mandatory those 150 listed and then 250, so on. So it has opened a huge gate for mid-sized firms even.
Yes, yes. And that's why I touched upon this particular topic of ESG rating, because it's an upcoming area of practice which chartered accountants can also come in and pitch in.
Yeah.
Correct.
Even the format, they've simplified the format from BRR. Now they've come up to BSRS, and now they've given a very decent format. It isn't very confusing and it is informative. The people will also understand.
Correct.
Right. So a few things. So there were a few questions before. I'll take up those questions till the time other questions come up. There was a question that was put up that if they're taking, how will, okay, if a credit rating is being taken by more than one agency, then how will this impact the decision making?
Okay.
So that was
It's like having credit ratings from or an external ratings from 2 or more agencies is nothing but a reassurance of the ratings and the creditworthiness that a borrower has. So if you are rated by only a single company as compared to another borrower who will be rated by maybe 2 companies at the same level, it gives a reassurance and a revalidation of the creditworthiness that each rating agency is giving out. So it only reaffirms and helps the borrower to attract much more investors or much more banks, and it is in a much better negotiating power to go out in the market and say that if I'm rated by CRISIL and ICRA both at a AA plus, he can that particular entity can obviously ask for the best possible terms of lending at the lowest possible interest rate. So the more the merrier, in short.
great. Then there was a question where it says, how does a credit rating agency operate where the issuer's disclosure levels are very low?
Okay. So a credit rating agency, as I spoke of, when it's assessing or when it's arriving at the ratings, it takes information from various sources. And when we speak of a non-listed entity or a private limited company, yet still a rating agency will need as much information as possible, and the more information and the more transparent you are in giving information, as I spoke of during the discussions also, the better it will be for you to get a better rating. And the comfort level for an external rating agency will be much more if you're upcoming and forthcoming with respect to your information sharing.
Sir, are there
So
any
yes,
sorry.
yes, yeah. So yes, for a private limited entity, the information will be less, and the information will be coming from the borrower himself. But the more you give and the faster you give to the customer, to the external rating agency, the better it will be viewed and better it will be for your ratings.
Right. Sir, are there any risk or disadvantages in taking this credit rating?
Disadvantages could be, so it depends upon what do you want. Do you want to take some borrowing from the bank, or you are not likely to take any borrowing from the bank? If you're not likely to take borrowing from the bank, then maybe it's not that useful, because at the end of the day, that is where it is mostly used at. And the better, or if the ratings are better, the only benefit or the most important benefit that you get out of it is your interest rates are lower. So if there is no borrowing itself, there is no question of reducing the borrowing cost or the interest cost. And that's the only disadvantage or the only situation where you shouldn't be taking a rating. But having said that, if you are going to take borrowings from the bankers or external capital markets, you can't do without ratings. And if you are taking those borrowings, it is always going to be beneficial for you to take these ratings and get yourself rated.
Okay.
It's basically a marketing tool within the financial space. So for your products, you go out in the market, put up advertisement boards, put out articles and show advertisement. In your advertisement, showcase your products and showcase the benefits. In the financial space, if you want to market yourself, this is the only way how you can market yourself.
I think the next question has already been taken up. I mean, the question is, how can one know if the credit rating agency has changed its rating, be it up or down? So I think we've already taken up that.
Sorry, I missed you in between.
How can one know if the credit rating agency has changed its rating?
Okay.
So
So,
I think that
couple of things which I guess I could have added in the presentation itself. All these rating agencies here in India need to have the consent from the borrower before giving out the rating in the public domain. Okay. So without the borrower's consent, they cannot publish the rating. Having said that, once the consent is available, they cannot or they will not take out the rating from the public domain until and unless the underlying loan or the bank or the bond or the investment that is there expires and is repaid. So you cannot withdraw a rating also, but you can stop it before going out during the first rating that comes out. That rating is communicated first to the borrower, and then it is published after taking an okay from you or the borrower. So one first rating or the initial publication doesn't go without the borrower's consent. The taking off of the rating doesn't happen even though you want it. That is the prerogative. Once it is rated and it is available in the public domain, it is the prerogative of the rating agency to pull it down. It is widely available on each rating agency's website. You just need to go on their website, type in the company name, and you will be able to basically find the ratings, right? And there is one aspect to it, as I spoke of, since it can't be withdrawn, your ratings will always have to be live. And if you are not in agreement with the rating that the borrower or the external rating agency is giving, you still should try and maybe convince them. And if they are not convinced and they want to downgrade a rating or give a lower rating, then the only possible option that you have is to get the rating withdrawn, for which you will have to repay the underlying loan or the obligation that you have, post which only they will withdraw the rating.
Right. So I think that's about the questions.
Great.
We're done with the questions. Then I would now ask Karan to continue to give a hearty vote of thanks. Then we can end our session.
Okay. Great. I hope I was able to address the questions correctly.
Yeah. So you covered really well. So it was like from the basic, what is credit, till how it is being done and everything. The whole range was covered well. Okay. So I think I think Karan has left. So thank you, sir, for such an informative session. It was a delight to have such information coming out and getting this such information. Thank you for the session, sir.
Thank you. Thank you. Bye-bye.
Bye.
Thank you for the opportunity.